Hello, ladies and gentlemen. Thank you for coming to this channel. If you're new on this channel, kindly subscribe or like and leave a comment after this. Also, check out my previous videos. Check out the things that I'm talking about. Of course, this is a financial channel, and we cannot forget that the reason we are here is so that we can learn, so that we can grow. Remember, as a financial guy, I am here to educate you, to elevate you, and to motivate you to become a greater you. So today we are talking about a topic that might sound technical to you, but I will try best possible to explain to you what indeed I do mean by this. So today we are talking about IRR. IRR basically means internal rate of return. So it is a financial term that denotes um, just how much you are willing to risk, how much return you are willing to get for a certain particular risk. And this rate is what you as a person or as a company or as a family or as a couple decide is your minimum return on any investment. Remember, what we talk about here is not expenses, what you are spending on, but more of what you are investing on. So how do you determine your IRR? I hope you have understood when we talk about IRR, what we mean. Basically, it is an internal rate of return. So you have various investments that you are choosing. So meaning that you have a limited amount of money, you're choosing between several investments. So you have to ask yourself, which investment brings the best return for me? So for say money that you have put in a savings account, it is the interest rate that you are given by the bank at the end of the month. Or if it is a fixed deposit account, again with the bank, it is the interest that you receive up to the end of the year. Remember, the IRR is calculated for a base period of annually or every year, so that if you have an investment that is maturing before the end of a year, then you determine the rate of that investment, and then you calculate it basing it on a year, so that you can compare it favorably, equitably against other investments. So for example, for a bank account, if you are given a savings interest rate of 1%, then you are given 1% on how much you have held for that particular year. So if you give a shorter period of time, then you receive a lesser interest rate. So if you put for 6 months, then it is the annual savings interest rate divided by half, because it is a half year. So for us to make it more reasonable, we base all our investments and level them out into an annual rate of return. So how do you measure or determine the IRR for various investments? We have talked about, of course, the savings internal rate of return. It was already given by the bank. Then the fixed deposit interest rate, that one it is determined by the bank, so you know beforehand. Many banks and financial institutions have this information ready. Then we have the money market fund. It is also given readily, but it is not determined until the end of the year. So basically, how you determine the internal rate of return, it is usually average it out based on the previous year's performance of the money market fund. So if it had 8%, then it had 10%, then it had 9% for the previous 3 years, then the rate is reasonably 9%. That is the rate that you can take for the future period. Then, of course, things to do with land. How do you determine the internal rate of return? If it is vacant land, then you determine, if you bought the land, say at 1 million shillings or 10,000 USD, then the repayment, if you are to sell the land after a year, it has appreciated by, say, 1,100,000 or say 11,000 USD, assuming there are no transaction or say land taxes and any fees that you pay for owning the land, then the rate of return will be the 100,000 divided by the 1 million multiplied by 12, so which gives you a rate of 10%. So that is how you value the rate of return on vacant land. Or for the dollars, then it would be 1,000 divided by the 10,000 USD multiplied by 100, which gives you a rate of return of 10%. Then how do you value, say, rental property? Rental property is based on the purchase price. Remember, the price changes. There is a purchase price and there is the market price. So when you're determining an internal rate of return for rental properties, you basically take the rate that the amount that you paid for such an investment, because again the market rate fluctuates each and every other time. So use the purchase price. So say if you bought a rental property for, say, 400,000 shillings, just an example, or say 4,000 USD, it's just an example again, those are not real values, and then you collect rent of, say, 40,000 for the whole year. So if you collect rent for 40,000 for the whole year, then it would be 40,000 divided by 400,000 multiplied by, again, 100, then it will give you 10%. So that is how you value the internal rate of return of rental property. How do you again value, say, the rate of return, say, on maybe you have a taxi that you're hiring out? Then it would be the income less the expenses divided by the purchase price multiplied by 100. So basically, if you have several investments that you are looking into, then say it is a rental property, so you could invest in rental property, or you could invest in a transport business, or you could invest in vacant land. So that is how you determine the rate of return for that. Then if you have an internal rate of return, which I would advise you should be above the inflation rate and at least above the minimum interest rate or income or percentage income rate, internal rate of return that you would get on the most secure investments. In this case, you are talking about things like government bonds, government bills. So if the government rate for the bonds is, say, 10%, so your internal rate should be at least 10%, meaning that you are incurring no risks and your rate of return is assured. Again, the reason government's bonds are very secure is because they are backed up by a government, and it is very hard for the government to default in payment. Because there is no risk, then take that minimum return. Then you can adjust it based on your expectations. Say if it is 10%, that is the amount that the government is giving per annum. Again, I'm saying annualize the interest rate so that it can be equitable across all investments. So if it is 10%, you could add, say, 2% above that, so that your internal rate of return will be 2%. Then if you determine that is your rate, then any investment that comes your way, because this is your policy, then you would not invest in any investment that gives you less than your internal rate of return. Of course, it is important. Again, if you are focused, if you are really diligent in your investments, then you must know how much an investment is going to give you and determine, for this level of risk, am I willing to give this amount of money? So remember, again, risk goes hand in hand with the internal rate of return, or with the interest rate that you should expect. If you have a very risky venture, then you again desire a very high return. Why? Because you are paying for the high risk that you are indeed incurring. So based on this, you are able to know, do I invest in this or do I not invest in this? So that is what an internal rate of return does. It gives you the ability to know, this is the rate that you need to have. So do I invest or do I divest? Again, some investments, the interest rate goes down over time. So you would be able to know, do I divest? Divest basically means you sell off the investment so that you can have cash and invest in an additional investment or plan otherwise. So that is the importance of having an internal rate of return. I hope that you have understood on how to calculate your own internal rate of return. Then, based on your risk appetite, again, how much risk do you want to incur? Remember, the higher the interest rate on an investment, the riskier the investment. For example, for the people who give capital to small startups, require a big internal rate. Why? Because as it has been determined statistically, 33% of small businesses that start out fail by the first year. So this person is incurring the risk that they are investing in your business that might fail, that there is around a 33% risk that your business will fail. So when they invest in your business, they might require that they get a good return. So what do? They ask you for a bigger rate so that they can cover their costs. Yeah. So I hope you have understood. Next time we are going to talk about diversifying. What is diversification? How can you diversify? How can you take higher risk investments and low risk investments so that you can get a good rate of return on your investments, so that you are able to make more from your investments and you're able to balance out your risk. Thank you once again for coming to my channel. Remember to subscribe somewhere here or here. Like, comment, and share this link. Thank you and enjoy the day.